Last week in FX, the yen and the pound have been the major talking points and will remain in the headlines and on the agenda of traders throughout next week. The yen strengthened past $100 for the first time since the Brexit vote. Dollar yen hovered around the 100 level throughout the week, and with numerous swings above and below, somewhat weakened the psychological taboo around this 100 level, meaning that the negative trend in dollar yen could extend on a sustained and stable fashion below the 100 level from next week. Eyes are slowly shifting towards the 95 to 97 zone. Japan will open the week with preliminary manufacturing PMI figures from August. Japan's manufacturing sector is in the contraction zone, which means below the 50 threshold. And if the data hints at a deepening contraction among Japan's manufacturers, we could see the expectations of a dovish BOJ resurfacing, yet the sell-off in yen could remain limited as the markets have lost their faith in the Bank of Japan. On Friday, Japanese inflation figures will certainly disappoint, with a further contraction in the deflationary territory. The CPI, ex-fresh food, the one closely monitored by the Bank of Japan, is expected to have retreated at the pace of 0.4% on a yearly basis. This is nothing exciting for the Bank of Japan and the government, who see their efforts being fully unrewarded. Of course, as the yen strengthens, we hear echoes of potential helicopter money or more monetary action, fiscal expansion. Nevertheless, officially, there has been nothing new on Japan's monetary and fiscal agenda. The market expectations are too high to be satisfied and therefore could prevent the BOJ and the government from unnecessarily throwing out more measures. In the US, the durable goods orders are expected to recover from June's disappointing 3.9% monthly contraction to a better-looking 3.5% in July. The second quarter GDP growth could, however, be revised lower to 1.1% on annualised basis from 1.2%, printed previously. If we do not see any major surprises on the data front, the expectations of a Fed rate hike will remain unchanged. The market gives a 20% chance for a September rate hike and less than a 50% for a December rate hike. Finally, it has been quite a busy week for the FTSE and the pound. Cable regained the 1.3 level on solid inflation, jobs and retail sales data in July. Next week's GDP should define whether or not the pound can continue surfing on this positive trend, as there is room for a further recovery given how short the market went following the Brexit vote. Now, regarding the data, we do not expect any revision in UK's second quarter GDP growth forecast. The UK's GDP most probably grew at a stable pace of 0.6% on a quarterly basis. The devil is in the detail though, and we will be closely monitoring the UK's trade performance and the business investments, as any weaknesses on these ingredients could bring forward the Brexit fears and re-pressure the pound. If we see a break below the 1.30 level, then we could expect the pair to go back to its bearish trend, which could be the beginning of a fresh selling with 1.25 level as a mid-term target. That's your wrap up for what to look out for in the next week's trading week. Keep up to date with our LCG daily market analysis on our website. Goodbye.